The tax moves you have to make before December 31st, 2026, before the window closes. 5 legal tax moves die on December 31st. Most people miss all of them. Which tax moves have a hard December 31st deadline this year? How did the new Trump tax changes create opportunities right now? And what one move saves the most money for most people? I almost missed this last year in December 2025. I had what I call a tax planning panic moment. My accountant called me on December 18th and told me I had 13 days left to make moves that would reduce what I owed in April. We went through 5 of them in a 45-minute call. I implemented 3 of them before December 31st. Those 3 moves saved me just over $3,400 on my 2025 tax return from 13 days of action. I am going to walk you through all 5 right now in April, so you have a full 9 months to execute them instead of 13 frantic days. The earlier you act, the more options you have. Every one of these moves is completely legal. Most of them are designed specifically to work under the One Big Beautiful Bill signed July 4th, 2025. Move 1. Max out your pre-tax retirement contributions. This is the single highest impact legal tax move available to the most Americans. Every dollar you contribute to a traditional IRA or pre-tax 401k reduces your taxable income by exactly that dollar. The 2026 contribution limits are $23,500 for a 401k, with an additional $7,500 catch-up contribution if you are 50 or older. The IRA limit is $7,000 plus $1,000 catch-up for those over 50. For someone in the 22% bracket, $7,000 contributed, $1,540 in taxes permanently avoided. That math never changes. That is $7,000 contributed and $1,540 in federal taxes permanently avoided. The money does not disappear. It goes into your retirement account and keeps growing. You can open a traditional IRA with $1 today at Fidelity, Vanguard, or Schwab. There is no minimum balance. The deadline to contribute for 2026 is actually April 15, 2027. But the sooner you contribute, the more it grows. Move 2. Manage your income around the ACA subsidy cliff. If you receive ACA Marketplace health insurance and you rely on premium tax credits to keep it affordable, this is now the most important tax planning move in your entire year. The enhanced premium tax credit expired at the end of 2025. The subsidy cliff is back. Hard. If your household income exceeds 400% of the federal poverty line by even $1, you lose the entire premium tax credit for the year. That can be a $4,000 to $8,000 swing on your tax return. For a single person in 2026, 400% of the federal poverty line is approximately $62,000. For a family of 4, it is approximately $124,800. Managing your income below that cliff is worth more than almost any other tax move available to you this year. If your projected income is within $5,000 of the cliff, talk to a tax professional immediately. The moves to manage it must happen before December 31st. After that, the window is closed for the current year. Move 3. Use the overtime and tip deductions while they exist. The no tax on tips and no tax on overtime provisions in the One Big Beautiful Bill expire after 2028. You have 3 more years to use them, but only if you document them properly during the year. If you earn tip income, keep a daily tip log. The IRS requires documentation to claim the qualified tip income deduction. A daily record is the strongest form of documentation. If you earn overtime, ask your payroll department to separate overtime pay on your pay stubs. The deduction applies to overtime compensation specifically. It needs to be identifiable as overtime, not just additional hours at regular rate. For overtime, the deduction is up to $12,500 for single filers and $25,000 for married filers. If you are in a job where you regularly work overtime and your income is under $150,000, this deduction is worth thousands of dollars per year for the next 3 years. Document it properly now or lose it. Move forward time your charitable giving for maximum impact. The One Big Beautiful Bill created a new above-the-line deduction for charitable cash donations. Starting in 2026, you can deduct up to $1,000 in qualifying charitable gifts, even if you take the standard deduction. This is significant because most Americans take the standard deduction and receive zero tax benefit from their charitable giving. This new deduction changes that for the first time. The deduction applies to cash donations to qualifying nonprofits. Get the receipt, keep the documentation, claim it. It does not apply to donations of property, vehicles, or stock. To claim it, you need a receipt from the charitable organization showing the amount and date. If you donate to church, a nonprofit, or any qualifying charity, make sure you get receipts and ensure you are tracking your total toward the $1,000 deduction limit this year. By the way, if you are getting value from this, hit that like button and subscribe right now. And if you are serious about fixing your credit and getting funded in 2026, grab my book, Credit Rewrite 800, the 800 Plus System, and get funded for your business. The link is in the description. Everything you need to get approved and get started is inside that book. Move 5. Harvest investment losses before December 31st. If you hold any investments that have declined in value since you purchased them, 2026 may be the year to consider tax loss harvesting. The Iran war and tariff-driven market volatility have created significant losses in certain sectors. You can sell investments at a loss and use those losses to offset capital gains you have realized elsewhere. If your capital losses exceed your capital gains, you can deduct up to $3,000 of net losses against ordinary income per year and carry the remainder forward to future years. This move requires careful execution. The wash sale rule prohibits you from buying substantially identical investments within 30 days before or after the sale. You must wait 30 days to repurchase or purchase a different but similar investment immediately to maintain your market exposure. In a volatile year like 2026, tax loss harvesting can turn market losses into a tax benefit. It does not recover the loss, but it reduces what you owe on gains you realized elsewhere. The HSA, the most underused tax account in America. If you have a high-deductible health plan, you are eligible to contribute to a health savings account. The HSA is the only account in the U.S. tax code with a triple tax benefit. Contributions are pre-tax. Growth is tax-free. Qualified withdrawals are tax-free. The 2026 contribution limit is $4,300 for individuals and $8,550 for families. If you are 55 or older, you can add an extra $1,000 on top. Once you have a balance you do not plan to spend on current medical costs, you can invest your HSA in index funds. After age 65, you can withdraw for any purpose, not just medical, and pay only ordinary income tax. Treat it as a long-term investment account. The HSA outperforms every other tax-advantaged account in the code for someone who stays healthy. Maximize it every year. The year-end planning window. How to use it. Here is how to use the 9 months you have before December 31st. Right now, April, you have 9 months. That is the advantage. Use it instead of wasting it. What do you expect to earn in 2026? What is your estimated tax liability? Are you above or below the ACA subsidy cliff? With a projection in hand, you can make intelligent decisions about retirement contributions, income timing, and charitable giving rather than scrambling in December. By September, run a mid-year check. Income changes, plans change. Your tax strategy has to change with them. As your income changes significantly from the projection, adjust your retirement contributions or withholding accordingly. By December 1st, run your final planning session. Final charitable donations, last retirement account contributions, any remaining tax loss harvesting. All must be completed by December 31st. Give yourself 30 days of runway. Action steps. Today, run a rough income projection for 2026. Compare it to your 2025 actual. Is your withholding adequate for the new law? Use the IRS withholding estimator to check. Today, if you receive ACA subsidies, calculate where you stand relative to 400% of the federal poverty line. If you are within $10,000, consult a tax professional immediately. This month, increase your retirement account contribution to the maximum if you are not already there. Every dollar above your current contribution saves taxes dollar for dollar. This month, if you are eligible for an HSA, verify you are contributing the maximum annual amount. Open one if you have not yet. By December 1st, review your charitable giving for the year, harvest any investment losses, and make any final income timing decisions before the year closes. The tax calendar has hard deadlines. The moves available to you on December 30th are gone on January 1st. No extensions, no second chances. You have 9 months right now. Most people will ignore this and then realize it in April when the bill shows up. So be honest. Are you actually planning your taxes this year, or are you just reacting when it's already too late? And which one of these moves are you actually going to use? Drop it in the comments. I want to see who's serious about this. Next video. This is where it gets more serious. AI is quietly rewriting how your credit is judged in 2026. Not just your score, your rent, your bills, your bank behavior, all of it is being tracked and evaluated. So here's the real question. Are you actually building credit, or are you being scored in ways you don't even see yet? If you think your credit score is the full picture, you're already behind. Subscribe. That one might change how you manage your money completely. If this helped, hit like and share this with someone who hasn't started planning yet. Check the description section below for more info.